as you know, is a professional trader, director for Inspirante Trading Solutions. He will be discussing spread trading strategies with BMD CPO futures. So if you've been if you are keen to explore this commodity product, or if you have been trading and would like to some ideas on how you can take your trading to another level, today will be a session that you must not miss. Michael will be providing an overview of palm oil futures, providing an introduction to calendar spread trading activities, as well as exploring intra-market spreads and trading opportunities with the BMD CPO futures. Advanced trading strategies will be touched on by Michael as well towards the end of the webinar. And right at the end, we have a Q&A segment where you can fire away at a professional trader and we'll get Michael to address them for you. All right, so if you can hear me clearly, can I please request that you type a resounding yes in the question box? Thank you, Yokui. Thank you, Nikhil. Ong, thank you so much. All right, thanks for letting me know that you can hear me loud and clear. If Michael, you're all set in the studio, I'm gonna hand sharing rights over to you.
All right, hey, thanks, Suri. Are you able to see my screen?
No, not yet, Michael.
Sure.
All right, before I hand the reins over to Michael to walk you through what we're going to cover today, at any point in time, if you have questions, please type them into the question box and we will go through them towards the end of the webinar. All right, Michael, if you're all set, I'm going to hand the reins over to you, Michael.
Hey, thanks very much, Suri. Hi, good evening, everyone. My name is Michael. Welcome, and thanks for taking time to join us in tonight's webinar. Special thanks to Phillip Futures for organizing this event. Now, it was not mentioned earlier, but today is actually the second part of a two-part CPO trading series. So for those of you who might be interested in part one of this series presented by Mr. David Lowe, you can get a web link from Phillip Futures. It's rather interesting too, so just take a look if you can. Now, first off, let's always start with the disclaimer, given the context of what we are doing today. So just give me a second and make sure this is going. All right, here we go. So now, take a minute to just read over it, especially in the context of what we are presenting today. Okay, so now let's take that out of the way. Okay, just a little bit about my background. Okay, I have been involved in derivatives for the better part of the last 30 years or so. I was trading in the last 15 thereabout. Now I'm currently a trader with Synergy Link Capital SLC, and we're basically a prop trading firm that specializes in trading listed derivatives. So we have recently launched ITS, which is Inspirante Trading Solution, as offspring of SLC. Now, what ITS does is basically on top of developing trading solutions and systems for our client, we also conduct professional trading workshops and mentoring program. Okay, and I think, or rather, I like to think what sets ITS apart from the rest of the guys in the market is probably the way that these courses are being conducted. Now, we basically get the group of active traders from SLC, like I mentioned earlier, and they are basically the trainers in our program. Now, these guys come from various backgrounds and they have vast knowledge and experience in both past and present market, as they are still actively trading in the market today. Now, essentially, you can think of our courses as being conducted by current market practitioners in the sense, yeah. Additionally, the ITS curriculum design is rather unconventional. Now, as we all know, the one perpetual constant of the market is that of change, right? But sadly, over the years, I have been a witness of seeing changes and how some of my peers have been falling off the wagon, so to speak, when they fail to adapt to the evolving market. So in other words, no matter what we can come up with or whatever we can conjure, what kind of formula, what kind of strategy that we may have today, will most likely become irrelevant as the market evolves in the future. So here at ITS, we aim to teach our students how to fish rather than giving them one, so to speak. And we go about doing that by not just showing him our methods. We basically break down our methods and bring the students through a process of our strategy formulation, right from where we started on a blank sheet, the research, the logic, and essentially how we evolve the whole process and come up with a practical strategy that we can apply into the markets. So in the end, we hope to nurture in our students the ability to adapt and evolve and stay more relevant, or rather stay relevant as market conditions changes, which they surely will over time. Okay, now we've done a few of these classes over the past years, both in Malaysia and Singapore. Okay, and I'm proud to share with you that most of our students have seen tremendous improvement in their trading performance. And we unfortunately are limited by our capacity because of the lockdown and stuff. So we have actually, since the start of the year, to stop all educational and training efforts. I mean, we did some seminars here and there, but the formal class was at a standstill because of the lockdown restrictions, so to speak. So in any case, for those of you who are interested in what ITS have to offer, do drop me a line. I'll leave my contacts at the end of the slides. Yeah. And I think now with that, I'm done with advertising ITS. So let's go on to do what we came here to do tonight. Yeah. Okay. Now, I would like to begin by sharing with you the rules that guided me in my trading. I think although this may be painfully obvious to some of you, I feel that these principles are what kept me alive and able to speak to you and still trade to these days after all these years. Yeah. For me, the most difficult part of trading is actually doing it with sufficient consistency and with profitability over time. So in the context of professional trading, my goal has always been to build wealth while ensuring long-term viability. So in essence, I approach trading like I'm approaching running a business. Okay, and therefore my consideration of risk will always take precedence over profit. And then with that, this slide will make sense then. The next three rules of which I'm going to share with you will be blindingly obvious. We always start with preservation of capital. Now, without capital, there's no continuity. In a simpler way of putting it, for whatever I do today, I have to make sure that I'll be able to continue doing or trading tomorrow. Now, we are not going to be 100% right all the time, no matter how solid and good our strategy may be. There will be time the market is going to prove us wrong, even if we are right. So the important thing here is that we are able to continue doing what we are doing, despite some setbacks here and there. So this is essentially about risk management, which is a very big part of any professional trading endeavor. Okay, and the next thing is obviously consistent profitability. We are in this for making money, obviously. And the thing I can share with you is this: we tend to approach trading in a very structured manner. What I mean is like, we will go about it the long way. We will take a idea and we research it, we back test it, and we test it some more in the market before actually fully deploying it with our capital in a meaningful way. So that is to ensure that we actually know and learn about the things that we are doing, and then continuously adapt and refine what we are doing so to get better results. Now, only upon fulfilling the first two conditions, then will we be able to talk about pursuit of superior returns, which essentially is taking on more risk, only and only after you build a buffer for you to be able to increase your risk appetite, so to speak. So if nothing else, at the end of this webinar, I hope you remember this, right? Risk management is never an option when it comes to trading. So do take that and remember it with. Okay, for tonight's agenda, I'll briefly talk about why I like to trade futures, and specifically I will be talking about BMD, the Bursa listed crude palm oil, which we call CPO from now, futures. And I will be exploring, or rather explaining, a spread trading strategy on CPO futures, which I regularly use till today. And then I'll be giving you some examples and how I go about doing it. So with that, now why do I like to trade futures? Futures is rather unique in its characteristic. Okay, it actually offered a lot of things that is just not seen in the other asset classes. Okay, just briefly over these 5 things that I want to talk about. First of all is leverage. Now, most futures are margined at about 5-10% of its underlying notional, meaning the minute you start trading futures, you automatically get a 10 to 20%, 10 to 20 times leverage factor. Now, a word of caution though, leverage is a double-edged sword, as you would have read somewhere, and it's true. It can work for you, and it will also work against you when you are in the wrong side. All right, so bear that in mind. Now, the other thing about the attraction of futures is basically the ease of execution. Now, there are very little, if any, restriction when you want to go long or even short selling in the futures. It's just as simple. Okay, and cost consideration. Futures trading is relatively cheap when you put in perspective what is the tick value. Okay, and these days there are as many futures as there are products to be traded. Basically, you can find a future representation for almost anything you can imagine for each kind of asset classes and each kind of representation in the market. And a lot of this actually have built up substantial liquidity and interest to be very viable for trading in the long haul. So that is mainly why I started trading futures, and I've been trading since to this day actually. Now, the main character of what we are doing today, the BMD listed CPO futures. I will talk about this slide later, but the thing to note here is crude palm oil futures is a physically, well, this particular version anyway, is a physically settled futures contract. I mean, so what it means is basically at the end of the last trading day, if you are still holding a position, unless you plan to deliver or receive obscene amount of tons of palm oil, you probably wouldn't want to be caught in that position. So with that in mind, if you're trading this, please pay close attention to the last trading day, first notice days and such. Of course, I will be mentioning this again because of liquidity concern. Generally speaking, the expiring month or the spot month, so to speak, will probably be trading a lot lesser than the other active months. Okay, but just keep that in mind, and this is a very important point to note when you're trading this contract. Yeah. The next thing I'm going to look at is the open interest in volume and market demography of crude palm oil futures. Now, as you can see on the chart here, the diagram here rather, the open interest has been steadily increasing over the years, although that we have a slight dip over the last 2. But if you were to look at it in terms of month-over-month volume, it's still rather impressive, especially this year. Now, this year we have a rather roller coaster ride kind of market. I mean, the market was like up a lot in the beginning of the year, then suffered a setback in around end of first quarter, and then now we're bouncing back all the way up again. So there was a lot of action, a lot of volatility in the market, and it was very interesting times. It can be dangerous too, depending on how you look at it. But basically, there is no shortage of liquidity and availability and possibility to trade. My bad. Well, the market demography, if you just briefly look at it, what I wanted to share with you here is basically the segregation of interest in this particular product. There are a quite even separation between the domestic and overseas, between the institutions and the locals. So in general sense, no one is getting a stranglehold on the market. In the sense, it's very evenly built with different interests and different perspective when we're trading this market, which makes it a lot more interesting when we come to trade it. Okay, I am going to cover a little bit about the fundamental factors that affect CPO prices. This is by no means exhaustive. Okay, the reason I will only do this in the context of this short period of 1 hour that we have is because I feel strongly that even though I'm only going to talk about spread trading tonight, the outright prices have a very strong bearing in the spread prices as well. Although it doesn't quite behave like an outright trade, okay, you need to pay attention even though you're just doing spread from this perspective. Okay, now very briefly, CPO, like every other agriculture product, is basically influenced by both demand side and supply side dynamics. We'll start with the supply side. When we talk about supply, we're talking about production. Basically, Malaysia and Indonesia, for those of you who are less informed, forms the bulk of the world's production and supply of palm oil. And in terms of production, we will talk about like inventory, how much is being held at this particular time, how much stocks do you have, and how much we import, which is a smaller number. And obviously, government policy in terms of levy and whatnot will also affect the production and willingness of the producer to produce more or less, and as well as the weather, which is actually uncontrollable, but we barely can make an educated guess. Then we have like for substitute, the price of substitute have a bearing on the palm oil prices as well, because when it's cheaper to substitute one with the other, the economics will make sense for you to actually order, rather for the user to substitute the cheaper alternative to the more expensive one. Now, with palm oil, the soybean oil, the rapeseed, and the sunflower oil basically forms about 3/4 of the world's edible oil supply. So they commingle in an intimate way. You need to actually pay heed to where the price action are for this substitutes as well as your own CPO market. Okay, on the demand side, we talk about the demand of palm oil. We're talking about the export to various countries that demand it as edible oil source. The primary three, or the biggest three that we can think of, is China, India, and the EU especially. Okay, now what are these affected by? Obviously, the price of the palm oil versus the alternative as well. The seasonality, like for example, the Chinese New Year, you will see a spike up in demand. The user may actually be stocking up just ahead of the season, and things as such. Okay, and government policy will also have a bearing on demand of palm oil, especially for example biodiesel. Right? Like Malaysia, we are going for B20. And in Indonesia, you're going for B30 biodiesel. So now that biodiesel demand actually is a very substantial chunk of palm oil's demand, approximately in the region of 20-25%, I think. And contrast it with the price of crude oil, which is the alternative if you look at it in that sense. So when crude oil is weak, there is very little reason to substitute palm into biodiesel, especially with palm prices at where it is these days. So these are the factors that would affect the supply and demand dynamics, and such affect the outright prices. I will encourage you to explore more. Now, that said, there is no way for you to know everything there is to know. Obviously, even if you do know, you might not be the first to know, and you might not be the most accurate one with the most accurate information, because these sources of information are rather segregated. There are, fortunately, your brokers or certain agency that specialize in this type of information that you can consider to take a look. And the reason I share with you this things is I keep track of it as best as I can, even though I'm trading most of the time. I try to keep track of the supply demand numbers, the projections. Now, the reason I do this is I want to get a gauge of where the market sentiment, the biasness is right now, the forward-looking nature of the market, and what the market is expecting. For example, like they were expecting, let's say for example, if they were expecting a major production spike and it didn't come, it basically means the price is going to spike because the supplier is supplying less than the market ever expected, for example, simply stating. Okay, so you may find your system of tracking all these things. How detailed and how far you want to go is entirely up to you. I find it rather relevant, so that's why I implore you to just take a look at this too. Now, where do we look for all these numbers? Now, other than MPOB, which is a Malaysia Palm Oil Board that furnished information every like 10 of the month for the previous month's production number and whatnot, there are various like the SPOMA, and ITS, SGS, AM spec, they actually produce certain number. They publish certain numbers actually every 5 days about export, production, and whatnot. So these are the numbers that you should pay attention to, because if you're like me and a lot of my peers that's trading this, it has everything to do with the intraday, or rather the price movement on the outrights, which will have a bearing on the spread that we are going to talk about in a while. Okay, and one more thing you need to know about CPO production is the seasonality of it. I'll read about the details from the MPOB website, which you can check it out. Now, basically, this is talking about, because of the weather pattern, there are low, moderate, and peak season in terms of production. Now, when it is low season in production, meaning there are less supply than otherwise, so that would actually be putting a strain on the supply side and be checking the price out on the supply side of the equation, so to speak. So if you look through this on the MPOB website, they have a very good explanation of this, and you can probably get a better understanding of why the curve trades in a certain way. All right, now CPO curve is like most commodity curve, is in contango most of the time, meaning the front prices will be lower than the farm prices because of carrying costs, insurance, storage, and whatnot. But there will be many times that it can also go into the contango, where the front prices are actually more pricier than the back months. And the reasons for that are multifold. Sometimes it's supply or delivery pressure, like I mentioned earlier, and the sentiment, general sentiment of the market of what's going forward, the forward projection of the production, supply, demand numbers, for example. And that is why I mentioned those fundamental points earlier. Now, this is the spot versus the spot plus 1 month as a spread over 5 years period. Okay, now if you look at the green color part of the diagram, that is when the market is trading in contango, and the red part is where it's trading in the backwardation. Now, they can actually last a very long time, but the point here I want to make is, if you were to look on the right hand side, the histogram, it roughly resembles a normal distributed curve. Okay, meaning there is a very strong tendency for it to revert to a mean, so to speak. And this is basically the basis of what I'm going to talk about in a while, the mean reversion strategy in spread trading. Okay, now there's another look at the palm oil curve. This I plotted all the futures contract that's available in the month of October this year. And if you look at the 4 curves from week to week, there's quite a substantial move. For the back months, it's more of a parallel move. For the front months, the front chart anyway, if you look at it, the gradient of the curve have also shifted with the move in the outright prices. That's what I meant earlier. Okay, so that have implication on how we go about doing spread and how we look at it, our stop points and whatnot, which I'll explain in a while. Okay, now why do I keep mentioning calendar spread trading and not trade the outright? Well, I suppose I could, but the reason I like spread trading a lot is because of this few points here. Now, spread trading essentially is buying one and selling the other. In the context of calendar spread, we are talking about the same contracts. So you are lowering risk considerably when you do it in that manner. And not to mention that you're actually lowering the margin requirement to trade as well. Now, a spread is actually about costs about 1/3 to do compared to an outright position. Okay, now a spread also provides a meaningful and interesting way to take advantage of relative value diversion. Now, you saw in the curve itself, right? The different part of the curve move in different way depending on projection and whatnot, and depending on where you are on the curve. And it's also an excellent way to trade seasonal trends. And you can look at it as a lower risk directional bet as well. Now, in a spread trading, or in the outright trading, if you think of it, there is really only one way you can make money. If you're long, the market has to go up. If you're short, the market has to go down for you to be profitable. But in a spread setup, there are actually a lot more ways that you can actually begin to profit. Before I explain how, just get some terminology out of the way, right? Now, a calendar spread trading is a strategy where we go about buying one contract and selling another contract of the same product in different expiration. Now, when we talk about buying or longing a spread, we actually buy the near month and short the far month, and the short or sell spread would be the reverse. For example, if I say if I'm buying the May-June spread for example, for commodities anyway, I'll be buying the May contract and selling the June contract simultaneously. Okay, the concept is a little bit like if you were to go to your money changer. Okay, when you're traveling, when you're planning to travel overseas, for example, if you buy basically the foreign currency, you're selling your local currency. In essence, you're doing a spread. Okay, because you buy one and sell the other simultaneously, although they are not essentially in this like a calendar spread, but that is what the spread is in gist. Yeah. Okay, now when we talk about ways to benefit from market move when we set up as a spread, when you buy a spread, you're basically expecting, or rather you're hoping that the spread will widen. Okay, how would this happen? Now, number one case is, for example, if you bought the spread, if you long the spread, and the near month rises while the far month falls, basically the spread opens up like an alligator mouth. So you will benefit on the long side as much as you'll be benefiting from the short side as well of your setup. Okay. Now, case number two, if the near month rises while the far month rises too. Now, as long as the near month rises more than the far, you essentially will still be profiting from this widening of the spread. And finally, the third possibility on the long spread side, if both months are falling. Now, as long as the far month falls more than the near month, you will still be profitable in this setup. Okay. Now, if we were to look at the reverse side on the short spread, right? Essentially, when you are selling a spread, what you're gunning for is basically a narrowing of the spread. So, like earlier, the case one where you actually have a near month falling while the far month rises, so you'll be benefiting on your position on both months. So that's one. Now, if both months fall, as long as the front month fall faster than the far month, you will still be benefiting from this position. And finally, if they go the reverse and both month rises, as long as the near month rises less than the far month, your position in the short spread will still be profitable. Okay, now with that out of the way, where do we start? Well, we start by picking a spread to trade. And then how do we pick a spread? We have to consider liquidity, flows, and opportunities. And finally, we employ a strategy that we use to trade the spread. I mean, the basis of where we enter and exit the trade, and where we place our stop losses and whatnot. So with that in mind, I would like to show you how it looks like on there. This is from TD platform. Now, CPO listed on Bursa has a total of 24 contract months at any one point of time. Okay, it's a consecutive 12 months and then alternating months up to 36 months outwards. Now, this is just the outright. We're talking about 24 outright months, and the possible combination is well, mind-boggling actually. So where do we look for opportunities, and how do we decide which pair and what combination should we do when we are choosing to trade this spread? Okay, we will consider a few things, but first of all, let's talk about the strategy as well, the mean reversion strategy. How do we establish it? We will do an observation and study the historical spread differential from the spread that we picked up, and then we construct sort of like an upper and lower bound of what we expect the value to be. Remember the earlier mean reversion chart diagram I showed you? Say, for example, you expect the market to be ranging between plus 50 and minus 50, for example. Then naturally, when the market goes down to minus 50 in terms of spread points, you'll be a buyer. And likewise, if it goes to reverse rate plus 50, you'll be a seller automatically in that manner. Okay. Then you put on the trades, like I just explained, and finally unwind the trades when it reverts to your mean or your objective, your target price, for example. And obviously, this consideration would also have to think. We also have to think about stop losses, which I'll be talking about a little bit more later. Now, let's start with the 1 month spread. The 1 month spread is basically, I'm talking about consecutive month spread, meaning like May versus June, June versus July, and so on and so forth. Okay, I have drawn up this diagram here from Bloomberg. This is basically the spot month versus the spot plus 1 month, the third and the fourth month, essentially. Before I go on, liquidity consideration, which pair do we pick, or where in the curve do we pick of our 24 contracts? Now, the most active contract at any one point in time for CPO anyway is from the third to the fifth month. This is where the liquidity, the action, the flows are most concentrated. So if I was trading it, these are the best, these are the areas or part of the curve that offers the most opportunity. Okay, now the 1 month spread, I'm looking at it from spot and spot plus one perspective on the long side of the spread. Now, if you look at it, it almost is never like a straight line up, right? There is always like some reversion. Look on the right with the histogram again, it represents very closely when we were looking at it 5 years, and this is just over 6 months thereabout for this current spread that we're looking at. So it's the same thing that I talk about. If you were to draw a line at plus 50 and minus 50, that roughly represent the boundary of what we can see here. Okay, and then the same thing applies. So we'll go long if it hits the lower bound of our targeted boundary, and we'll go short if it hits our upper boundary of our sell target. Okay, this is how it will look like on the trading platform. This is the exchange listed 1 month spread. You see from this Jan all the way to April, May. And as you can see, the highlight here is basically the liquidity in the market. You see, at any one point of time, at each tick, there are sufficient tap and liquidity for you to do what you need to do. Okay, so it's a matter of where you pull your trigger and where you exit. Okay, now likewise, the 2 month spread. Not very different in the sense, except this is a longer time spectrum, meaning we'll take the 3rd month versus the 5th month. Now, what happens when you drag this out? There are more time in between the 2 contracts, meaning there are more uncertainty. So this type of spread, as the longer you drag, the more uncertainty you introduce into this spread setup. That means there will be more volatility being introduced to this particular position as well. Again, if you look at it over the course of the 6 months, or rather the past 9 months or thereabout, the histogram still indicate a very strong mean reverting tendency. All right, there hardly is a line that runs away on the spread. Oh, by the way, the spread is the lower part of the curve. The upper part of the curve is actually depicting the outright prices for the 3rd and the 5th month. So in that sense, again, we apply the same principle. We draw a upper and lower boundary lines, and then we go about making our decision on when we want to trade this. And this is how it looks like. And obviously, because of the increased uncertainty and volatility in this type of setup, the deck is necessarily a lot less liquid than the outrights, the 1 month spread. Now, you need to know one thing. Whether it's a 1 month spread, 2 month spread, 3 month spread, or even a 10 month spread that you decided to do eventually, these are all made up by outright months, meaning to say they are all interrelated. Okay, I'll give you an example. If I was talking about the Jan-March 2 month spread, essentially you can think of it as Jan-March 2 month spread, or you could also think of it as combination of a Jan-February spread and February-March spread. They are much the same thing. Okay, and you could also think of it in terms of the outright. So it's basically the Jan-Feb-March contract that you need to consider when you are evaluating the attractiveness of the price of entry or exit that you're considering, whatever setup that you have. Okay, now next is a butterfly spread. Now we have the I showed you the 1 month spread and the 2 month spread. Of course, there are various other combinations that you can consider at the end of this. Now, a butterfly spread is essentially a spread versus a spread. So, for example, if we talk about a 3-4-5 butterfly spread, essentially we're longing the 3-4 spread and shorting the 4-5. Okay, it's like the wing and the body sort of thing. Now, why do I want to talk about butterfly spread here? There's 4 months involved. It's more costly and everything. The reason is this: if you were to look at the butterfly spread, right, it's essentially a spread versus a spread. When you do this type of spread, you lower the volatility inherent in that kind of contract considerably. Okay, and best of all, it still mimics a roughly similar kind of distribution diagram, meaning that the risk reversion nature is still very apparent there. Okay, now you would expect a narrow range like you see here. Okay, we are talking about the 3-4-5 here. So basically, you see from like minus 50 plus 50 earlier, we are narrowed down to about plus minus 20 there about. Okay, it's lower both. Obviously, you probably will have less extremes in this sense. So you can consider trading this too. I like to trade this a lot, and actually, it makes a lot of sense for this kind of setup when you're considering how the outrights have been so volatile lately. All right. This is how a butterfly spread will look on the trading platform. This is listed on the exchange as well. Now, why did I mention this again? Remember, I just mentioned about how the spreads are made up by individual months. The butterfly spread is no different, all right? Instead of 2 months, it's just made up by 4 months, if you were to look at it in that way. So I leave it to you to think about this. But what I meant is the interrelationship between the different types of spread, be it the butterfly spread, the 1 month spread, 2 month spread, or even the longer 5 or 10 month spread. They are all interrelated in a way. They have to be, because otherwise that would mean that people like myself will be jumping in for a riskless kind of profit. Okay, so in that sense, you can look at it that way. There are many ways to go about entering and exiting a position in a sense. So do think about that. Now, I mentioned about outright market move. Okay, the reason I was touching on fundamentals, even though I'm just talking about spread trading, would seem weird to some of you. Okay, but my personal experience in trading CPO for the last couple of years is that the outright will actually have a strong bearing on the spread as well. Now, this is especially important because consider our mean reversion strategy. We are trying to find the lower bound and upper bound entry and exit entry levels, meaning that we are hoping the market will revert to its mean or its long-term mean for us to be profitable. What happens if it breaks the upper and lower bound and keeps going? Can that happen? Of course it can. Okay, and we need to be alert to what caused that kind of movement, and when it happens, we need to be disciplined enough to tell ourselves that we are in the wrong end of this position at this point in time, and we need to get out of the position. Now, on this diagram, what you can see is basically the Jan-Feb calendar spread versus the spot month, which is the third month essentially, outright prices in white. Now, you can notice that as the price moves, the spread will move somewhat also. It also depends on where you are on the curve. What I mean is this: if I was talking about, let's say, May-June spread, it would probably be a lot less trendy versus if I was talking about a Jan-February spread. The reason why I'm saying this, now if you look at the chart, we basically draw this over the month of October. In October, basically the spot month is already January, which is a Jan-February contract spread contract that we plotted here, and this will be receiving the most interest and attention at this point of time when I'm plotting this chart. Okay, now when the when the outright market actually make a big run and was on the verge by late October of breaking a new high, when it crosses 3,000 over, it actually caused some change in the underlying tone of the curve. Okay, so basically the front months are feeling the heat because of already a supply concern, a low inventory number and whatnot, and the pressure of approaching expiration because being the spot month and whatnot means that January will receive extraordinarily disproportionate kind of pressure when the market is going one way, especially in this case up, and you could actually expect the spread to go up too. And the next diagram I want to show you is what I just mentioned. Okay, now I plot the Jan-Feb, the Feb-March, the March-April, and the April-May spread to compare. Now you see the lower three curves are just away from the spot month of Jan as we are talking about this, and when the outright prices start moving in October, mid-October, look at how fast the Jan-Feb spread start rallying versus the other contracts, although they are all in the same direction, but the Jan-Feb at a very, very substantially faster pace. So what does it mean in terms of spread trading? Now, if you're trading the Jan-Feb at that point of time, okay, it would probably mean that you already broke the upper bound by quite a bit, and that's a time where you need to take into consideration your own stop loss and the general consideration of where the market is, the sentiment, and what are you looking for, what the market feels about the few months going forward. And that's where you sensibly tell yourself you need to get off the spread if you're on the short side, which you probably will if you deploy this strategy. Now, this is very important. We talk about preservation of capital, and this is serious, guys. So you need to consider all this in the context of how the whole market is trading into this strategy, so that you know it is a time to be not aggressive, but rather be conservative and get out and reorganize and relook again at all your spreads. Because I showed you a 5-year chart earlier. You saw how the curve can go from contango to backwardation in the flip. And it can go on for a while too. It doesn't mean that you cannot trade this, you can trade this strategy. It's just that you need to be aware of the range and what the market is doing and what the market is telling you, even from the outright. Okay, now with that, I come to the last slide. Now, but before I go to Q&A, I did not include this in the slide, but I would like to talk a little bit about the numbers I was talking about. Sorry, the synthetic trading in CPO. Now, remember I mentioned to you that basically all the type of spread, all the possibility are, if you break it down, are made up with individual outright contracts. Okay, and the price relationship between each type of spread, each combination must also hold a certain type of relationship, relation with the outrights and the other spreads as well, because they're simply a different makeup. That's all. Okay, for the HFT, the high frequency traders. Okay, now there is a very common thing, especially in CPO, for them to be arbing for this kind of inconsistent relationship. Now, because of flows, because of need, because of contrasting interest or trading decision that needs to be made when you're trading in during the day, mispricing happen a lot. Okay, and when it happens, you can be very sure that people like ourselves will start jumping in and start to correct it where it should be. So now, when you are trading this, for example, all right, you need to consider how you can set it up, how you can exit. For example, you do not necessarily have to look at just the listed spread combination. You can look at it as a combination of different spread, combination of different outrights, and made it in a way and construct it in a way that most suit your style and your objective in trading this particular type of product. Okay, so now with that, I'm done with the slide presentation. I will leave you guys to the Q&A now. Siri, would you take over?
All right, we have our questions on hand. First one is, I'm currently trading outright CPO futures purely based on technical analysis without paying attention to fundamental news. Can I do the same for this calendar spread strategy? Perhaps purely based on statistical or quantitative analysis. What do you think, Michael?
Okay, great question actually. Now, while I oversimplified it when I mentioned, because of the limitation of time, I can't really go too much into the mathematics and the details of the upper and lower boundary. When I said draw a line across, I was half joking saying in that manner, because when you actually look at it visually, right, there is a structured way of determining where the upper and lower bound based on a certain percentage confidence that you want to achieve to determine where it is on the chart. So statistically speaking is what we come up with, the boundaries of the upper and lower bound that we talk about. That's one. Can you trade it technical? Definitely, we do it all the time. I mean, that's the reason why I mentioned about how the outright prices may actually have a bearing on the spread prices, because they move in different manner at different time when you are at actually different part of the curve. Okay, so that is actually one way of trading this as well. But the bottom line and the important thing is this: whichever method that you choose to adopt, okay, know that the risk management part of trading is not optional. Okay, and the very, very important part while you're experimenting a new strategy and whatnot is to come back to the day and tell yourself that I can still be able to trade tomorrow even if I didn't make it with this trade. Okay.
All right, Michael, for question 2, what is the best time interval to trade this strategy? Can I trade it intraday or only based on daily price movement? What do you think?
Okay. Now, the CPO has been exceptionally volatile this year. I mean, previously as well. Now, my trading horizon, it really isn't fixed. I go anywhere from 1 day or within an hour to like maybe a week or two for this type of spread trading. It depends on the market's volatility. It definitely is tradable. I mean, like today, I flipped a few times in some of the spreads, simply because there's some big move in the morning. It was slightly down, and then towards the end, near 4:30, there was some buying up as the dealers close up on their books. So yes, definitely possible. The same principle applies. You just need to observe like where the interests, where the flows are, and when do they come into the market. And basically, it's no different from what we just explained. Okay.
All right, question 3 is, what is the most efficient level to place take profit and stop loss in terms of ticks? What is the ideal risk versus reward or win or loss hit ratio to use?
Okay. Now, when we talk about what we talk about today, mean reversion strategy, it is actually a statistical extreme kind of setup. What it means is like, for example, okay, for lack of better deliberation, let's say if we draw a Bollinger Band over the spread curve, then what we do is like we take two standard deviation. So from a statistical viewpoint, two standard deviation is a very rare occurrence, somewhere in the ballpark of 96% thereabout, correct? So now when we enter a long when the market is the other side, negative two standard deviation, we are actually trying to buy cheap in our mind. Basically, we think if the mean reversion holds true, there should be not much downside, so to speak, and we do expect the spread itself to revert eventually to the central mean line. So in that sense, if you take two standard deviation upside versus a shorter downside stop loss, I think the payoff or the risk reward ratio is rather substantial, easily 1 to 5 and more actually in my in most of my cases. But that's it. Okay. It doesn't mean that you always be perfectly aligned in the sense that you will hit a upper and lower boundary. That is a trading decision that you have to make based on your risk preference, your risk appetite, and certainly your consideration of how comfortable you are entering the market at a certain time, let's say even before the second deviation, before it hits the second deviation, for example. Okay.
Question 4, how can I form a trading strategy around these spreads? For instance, what are the technical indicators that can be used for entry and exit, Michael?
Okay. The simplest that I can think of is the Bollinger Band that I just mentioned. Is basically a moving statistical measurement of the central line or central mean line of where the spread is. For example, if we're talking about spread here, and then again, let's say if you draw it at two standard deviation away. So now, instead, statistical inferences, it means it's actually a very rare occurrence for it to happen there. And if you believe in the central central core of what we are talking today about the mean reverting property of this particular type of setup, then it would mean that if you actually hit a lower bound of your Bollinger Band, you'll be a buyer, and naturally when it hits up, you'll be a seller. That would be oversimplifying it, because you still need to consider relative level based on historical level of where the spread usually is compared to the last year, the year before. You can read it up as much as you can, versus where the outright markets are. The outright markets are hardly static, right? So at different level, there is a different indication whether the market is in contango or in backwardation, or what is the expectation and general sense of sentiment in the market will all have a bearing in your decision. Would that answer your question?
Thank you, Michael. We have question 5. The question is, do I need to pay attention to the open interest, volume, or market depth of a calendar spread? Does it have any influence to the spread's direction?
Good question. Now, although I said earlier, whatever spreads that you can come up with is essentially the made up of the individual months, correct? That information, or let's say if you notice a very strong volume in a very particular setup. Let's say if we were looking at the something further, for example, if we talk about 5 versus a 10, for example, you notice a very strong in volume or interest, which indicated interest of setup in that particular combo. So what it means is basically you could expect a lot of people will be trading these two, and a lot of people will be holding position in these 2 months as well. And depending on where you trade versus what you are doing, again, you look at it in terms of the what you have already set up or what you plan to set up. It naturally will offer a lot more opportunity as well. Okay.
All right, number 6. What is the average holding period for mean reversion?
Depending on the type of spread you do. We mentioned 1 month, 2 month, and various other months. That's all possible. Generally speaking, right? For spread wise, I rarely do beyond the first 12 months. Liquidity is one thing, and in fact, if I take out the first 2 months because of spot expiration consideration and liquidity tends to be dry on this particular contract months, I got about 10 months to work about. Now within these 10 months, usually, like I said, the 3rd and the 5th months are the most are the ones that with the most attention, and then there are some months that are also of special interest, like May and November, for example, because of the seasonality point in the CPO supply, rather production curve. For myself, I trade all kinds of spread. So my holding period for all this, like I said earlier, it can range from like within the day to maybe like no more than 2 to 3 weeks, generally speaking. I do not have have a lot of experience holding any spread position beyond like a month actually. Most of the time, if I'm wrong, I'm wrong. I will be out very soon once it hits my stop loss, or I will be holding a position and it will be mean reverting in next. Now, because of what I just discussed today, it's a mean reversion, meaning when the market hits an extreme, you expect it to somewhat rebound quickly because it's an extreme. If it does not, then it's not an extreme, rather a new trend or a new price range is probably establishing itself. So in a sense, it usually won't be long, but it can be arranged anywhere from 1 day to maybe about 3 weeks to a month. That's all.
Next, we have, apart from correlation between the outright futures and the calendar spreads, how do you assess the impact coming from CPO's premium or discount against soybean oil or even BCE palm oil?
Could you repeat that? I missed some part of that, sorry.
Sure. The question is, apart from correlation between the outright futures and the calendar spreads, how do you assess the impact coming from CPO's premium or discount against soybean oil or DCE palm oil?
Okay, that's a very good question, which I actually was supposed to mention, but I think I took it out of the slide. Okay, in any way, palm oil does not trade in isolation, right? I said earlier, it is one of the 4 biggest edible oil supply in the world. So in terms of, if you look at it as the other oils as a substitute, then their price action will have a bearing on CPO as well. So when we look at it, for example, I'll give you one example, a very popular spread called a POGO spread, which basically measures palm oil over gas oil. Now, generally speaking, because of the biodiesel program, it will only make sense when palm is trading relatively cheap to gas oil. It makes sense to substitute some part of palm oil into biodiesel. Okay, and vice versa. If it actually trades like where we are right now, the POGO spread will probably be trading a positive. It's actually not probably, it's trading a positive, and that would indicate that there will be actually less use for palm into biodiesel because it doesn't make economic sense. Of course, the government will have some say in it. Like for example, Indonesia government, they have their own program of subsidy, and of course that can't last forever. But in that general sense, when you observe this kind of spread premium and discount against the substitute or competing products, for example, you get a sense of who is in the lead and what will happen. For example, in this POGO spread, for example, where we are right now in a positive territory spread, right? Now, either the government had continued to print money and support the subsidy program for this kind of biodiesel program, because it doesn't make economic sense otherwise, or they will stop the program at some point in time, or they will try to lessen the program at some point in time. It becomes less effective. That means that the market will probably be flooded with a lot more palm oil supply that doesn't go into biodiesel refining. So that, in a sense, will have bearing on the forward-looking part of the curve. Okay.
Michael, how do you assess mispricing? Can you give some examples? And do I need to use fundamental analysis to calculate such mispricing?
Okay, when you talk about mispricing, I'm not sure if you're talking about mispricing between the individual contract months, or you're talking about mispricing between the various products. If you're talking about between, let's say, for example, soybean oil and palm oil and crude palm oil, the concept of mispricing is only applicable if you're an arbitrager or you're a user, meaning you could actually effectively substitute one for the other, or you could trade one over the other, depending on what your use is. Now, if you're talking about mispricing in the market between the different contracts of the palm, okay, it is relative to what is available in the market. For example, I told you earlier, there are all sorts of listed calendar. Say, for example, if you look at a listed contract, calendar contract, let's say the May versus the June contract calendar that's listed on the exchange, and then you look separately at the May contract outright and the June contract outright, and you realize that you could actually buy the outright May and sell the outright June at a better price than what is inferred by the May-June calendar spread, then obviously there is mispricing. Generally speaking, this does not happen often, or it wouldn't last very long, because for people like us and HFT, we will jump in and we'll make sure this really doesn't exist for anything beyond a split second. Okay.
All right, our last question for today is based on your experience and historical price activity, is there any way to gauge how long will backwardation last before reverting back to contango and vice versa?
Okay. There is very hard to say a fixed time. Okay, you must understand the reason why we fall back into backwardation is usually because of the forward-lookingness of the product itself. Say, for example, okay, if the market is generally in depression, or sorry, my bad, if the market was generally in a bullish tone and mode, they expect, let's say, supply to actually gradually dry up in the coming months. So that actually will present a few challenges. Now, the spot month, which is nearing delivery because of expiration, people will be scrambling to try to get their hands on whatever is available stock out of a very short kind of inventory or supply situation. So they'll pay up the front months. As well, they could be looking at the forward commitment. They were thinking that probably coming next month, the same supply condition would apply, and we will be doing the same thing again. Rather than scrambling to pay and grab whatever we have right now, which we can't in any way, we might as well just pay up in the back months. And when time comes, we are actually secured of some supply, if you're on the physical side, that is. Okay. Now, you multiply this kind of thought by the magnitude of players in the market, like myself, for example. If I read from the numbers, then I suspect that the market is turning in the sense of the supply side, for example, drying up, the weather condition dictating that the supply will probably be low and the demand is high, say, for example, because of festive season or because of reopening of certain markets, like for example, China, India, whatnot. And this will present in a way that you remember the curve I showed you earlier. I mean, most of it actually shifted, but they shifted in different magnitude. Okay. Now, when you have enough of expectation built into this forward-looking manner, then the curve will revert itself from a contango to a backwardation, because you are seeing no reprieve in the forward curve of the crude palm oil. and you have to keep paying higher in a sense. This will only revert itself when supply catches up to demand and whatever your expectation is, and that doesn't happen overnight. Say, for example, if this was the case right now, if I was a producer, what will I do? I will start increasing my production. I'll start increasing my production capacity and whatnot. Now, for me to be able to catch up to that kind of expectation and to fulfill my orders and whatnot, it will be a couple of months down the road. By then, if I do that, there will be a lot of my competitors will be doing the same. And eventually, the whole market will be catching up. And usually, it will, well, overshoot in a sense. And at that point of time, you'll be reading the numbers again. And we're thinking, okay, now we have a bit of a build in inventory, and we are approaching the low demand season, for example, and you naturally see the curve revert itself. I can't say as to how fast, but it will happen in terms of the information is actually in all the numbers, the forecast, and whatnot, which is what I mentioned earlier. So generally speaking, it will take a couple of months at least. Okay.
All right, thank you so much, Michael, for the very insightful webinar. And thank you to our wonderful audience for the really technical questions as well.
All right, thank you, guys.
All right, to the audience who would like to view part one of this CPO series, I have left the link in the chat box so you can pick it up from there. Also, look out for our post-webinar follow-up email for the links to upcoming webinars, the webinar for part one, the link to part one, as well as a link to the video so you can revise what was covered today. All right, for those questions that we didn't have time for, we will address them offline. And thank you once again for joining us for today's webinar.
Thank you, guys. Good evening, everybody.
Good night, and see you in our next webinar.